And there it is, the closing bell at the New York Stock Exchange, ending another trading day for Wall Street. And it was a choppy day. The Dow Jones ended just within positive territory, up about 67 points.
The Nasdaq and S&P ended the day in positive territory. Both are up around 0.25%. So joining us now is Frances Stacy. She is the Director of Portfolio Strategy at Optimal Capital. Frances, welcome. Thanks very much for being with us. So, it feels like volatility has become almost routine, but what was driving the markets today?
So today was kind of interesting, waiting, for the Fed minutes to come out at 2 o'clock. And then there was a little bit of a lag effect, but then the markets rallied after that because really essentially the Fed was still enormously hawkish. But that was from the middle of June. So that was, a while ago in economic data terms. The economic data has gotten weaker since then. So the markets happily priced in the fact that the Fed is probably not going to continue that sentiment fully into July. Just because you've got the, Atlanta Fed projecting negative 2% growth for the second quarter. That would be 2 quarters of negative growth, which is quintessentially a recession, although that's now under debate. You've got a lot of the commodities that, participate in the CPI falling off. You've got oil and energy now finally breaking down. And so you're really starting to see that what the Fed has already done is having a real effect on growth out there. So we think that, markets are starting to price in, is the Fed going to remain as aggressive now that we're seeing some of these things come off?
That's what everyone wants to know. And Frances, according to a report released by the U.S. Labor Department earlier today, the number of job openings fell in May while the number of hires was relatively unchanged. How significant are these figures and what do they say about the current state of the economy?
Yeah, so the Fed's whole justification for a soft landing, which means no credit crisis, is the fact that they expect that this labor market is going to loosen up a little bit. It's not going to be as tight, which means that wages are going to stop going higher, which means that the higher wages are going to stop putting pressure on profits, right? That's their whole justification for what they're doing and how they're trying to mitigate inflation. They're threading a needle that's very, there's a lot of room for error. So this is falling in line so far with what they've said, which means that, the jobs market is starting to get a little looser, a little looser, a little looser. We also see jobless claims going up a little. And Jay Powell has acknowledged that, the unemployment rate is going to tick up, with their policy adjustments. But then that's all justified by, of course, trying to put pressure on inflation.
Well, against that backdrop, there are these ongoing concerns that the U.S. is on the verge of a recession. Would you agree? And what's your advice, Frances, for any Americans, who are struggling with these concerns?
So from my perspective, I think we are already in recession. I think that will be confirmed by the next GDP print. And now they're saying that really the definition of a recession is a meaningful slowdown across all the sectors. But we are actually seeing the early signs of that. Most of the commodities have rolled over, including now energy on a lagging effect. However, energy, like, for instance, oil, how it affects the CPI numbers is going to have a month or two lag effect. I think that rents are going to remain, onerously high for a while, which is a big component of CPI because of the fact that people, housing is getting less affordable to buy because rates are going up, right? So you're going to have persistently sticky inflation numbers with the backdrop of slowing growth. And the problem is that the Fed is going to remain aggressive. And they've said that now they're watching headline inflation, which is CPI instead of core, which includes energy and food. Which all of these price drops in energy and food now have lag effects, and they're going to continue to be aggressive. The problem with that is we have a record amount of debt in the system to service. And the last time they tightened, they over-tightened. And they put, they got to a point in September of 19 before the pandemic where they had to actually start purchasing again bonds for the balance sheet and adding to the money supply and easing aggressively because there wasn't quite enough liquidity in the system. So the whole justification for a soft landing is that they're going to take this bubble from the pandemic and all of the stimulus and all of the supply chains concerns and all of the inflation that occurred, and they're going to unwind it and try and get us back to 2019 before the bubble started to kind of blow up that caused inflation. But the problem is that they're doing so many things at once. They're reducing the balance sheet, they're raising interest rates all at once, that for them to make a policy error, is actually highly likely, just because, you know, each one of these things has a lag effect and the system doesn't have time to recalibrate. So I think that we are in recession. And I think that there is a very good chance that we are going to have some kind of credit event. I don't know how contagious it's going to be, and that will determine the damage and also how quickly the Fed pivots. Now the consensus is starting to agree with me, because now traders are starting to price in rate cuts for 2023, even though we haven't seen inflation back off at all. So that tells you right there that the bond traders are already saying, hey, Fed, there's so much debt in the system, and every time you raise rates and you reduce the money in circulation, you're actually reducing the size of the system. People are putting things on credit cards, and every time you raise rates, it's harder to service that debt. So those defaults are going to go up. And that's the thing. Bond market's saying, nope, Fed, sorry, you're not going to get that far.
So the bond market not happy with the Fed, what the Fed is doing, and Frances Stacy says we are already in recession. Well, Frances, thank you so much, Director of Portfolio Strategy at Optimal Capital. We appreciate all of your financial insight.
Thank you so much for having me.